Thank you, gentlemen, for joining the call. Part of the IIA Madras chapter, I'm Ravi Viragwan, to co-host the session. I have with us two eminent speakers today. The topic is on risk management in mutual funds, and this is a very hot topic today, at least from the India industry perspective. A lot of new circulars have been put in place, and risk management today is a very, very hot word, along with risk-based internal audits and other circulars as well. So thanks for joining, Milind and Kalpita. A small introduction about Milind and Kalpita. Milind is a qualified cost account management graduate, uh, varied experience across various organizations. And I know Milind personally for quite some time, and he's a great person to work with and very knowledgeable. Now he's the chief risk officer. He was a chief risk officer. Now he's in charge of chief, operations in Nippon India Asset Management. This is one of the biggest mutual funds in India. And he's been in the industry for 18 to 20 years. I've learned a lot from him. And thanks, Milind, for joining the call. And then I have Kalpita, chartered accountant from the Deloitte firm. She's been in chartered accountant for the last 14 years. And interestingly, I also know for quite some time. Very knowledgeable person, one of the experts in this industry, especially mutual funds and broking and other related with financial services industry. And she's working from the Bombay office, and Milind also is joining us from his Bombay office as well. And thanks once again for joining. Have a great session, Milind, and Kalpita, thanks for joining, and over to you, Milind. Thank you.
Yeah, thanks, Ravi. I think thanks for the kind words. Obviously, we have been working along for quite some time. And thanks all participants and basically the IIA chapter Chennai to give me this opportunity to present what risk management is in mutual funds. So maybe who would be putting up my presentation? Do I need to share it on my own?
No, I will put it up, Milind. I'll put it up.
Sure, thanks. Yeah, okay, thank you. So I think here I am from Nippon India Mutual Fund, basically presenting you the risk management in mutual fund industry. And basically, I would present what we have been doing in terms of risk management. I have overseen this risk management function as the chief risk officer for almost 5 years before I moved into heading the operations piece. So I will take you through the risk management in mutual fund industry. So maybe the next slide. So I think every time people ask me what is risk management and what is risk management in mutual fund industry or risk management in any industry, I think for me the simple way of explaining you risk management is typically what is it that you guys are seeing on your screen is nothing but a traffic signal, and which is a uniform signal followed globally. So typically, as I'm saying, maybe if someone of you can voice out what red stands for is stop, amber is wait, and green is go. So this is the universal instructions being given to all traffic commuters. If you're driving, if you're walking, maybe the signs will change, but technically this is the broad thing that red means stop, green means go, and amber means wait. So if you move to the next slide, I think Kalpita, would you be able to tell me what this is? Maybe instead of unmuting everyone, or maybe what is this? How does the signal operate typically? It is when you're driving. Yeah.
Yeah. So the red says stop. So when you are driving, red is an indication that we have to stop. The yellow says that you have to be ready, and the green is like, go. So these are the typical understanding of the signals, and Milind definitely will put this up from a risk perspective. What
Right.
does the signals represents, right?
Right. So if you are on the go, basically if you're moving, then it is first green, then it becomes amber. That is where you slow down, and when it is red, you stop. And when you have already on a halt and you want to start, the red becomes amber and amber becomes green. Okay, so amber says start your engine and green says go on the road. But technically what we observe in India is between red and green, we are very clear. Red is stop and green is, go. But amber actually says either you slow down or you start your engine. But for us, when we are on the go and from green to amber, before it becomes red, we in fact increase the speed and we want to jump the signal. Typically, when you are at a stop, you start your engine and you're on the roll in the amber itself. Now, this is where in any process, the risk emanates. Because wherever there is an amber sort of an situation, we should actually slow down or start our engine, but we actually overspeed and tend to jump the signal. And that's where major accidents are caused. And that is what risk management is all about. In any process, you have to identify these amber kind of situations and build the entire control process around that. Otherwise, red and green are very clear for all normal citizens of any country. So this is what I just wanted to explain you basically what risk management is all about. Yeah, Kalpita, the next slide. So as I said, risk management is nothing but to manage the amber in any process, whether you are either the process is on the roll or you are initiating a process. So this is all about risk management, is nothing but to manage the amber. So this is a simple way of actually telling you what risk management is all about in any field what you take. If you sit back, I think you will appreciate what I have been trying to communicate to you. Yeah. So basically, I'll cover what is all that happens in the risk management in a mutual fund. One is we have a risk governance framework. We at Nippon obviously follow enterprise-wide risk management. Then we also have investment-related risk management, which is our bread and butter, which includes market, credit, liquidity, and others. And then you also have information and cyber security risk management, which is also part of the risk management domain in a mutual fund. Yeah. So in the risk governance framework, basically this is all about what is the framework, how does risk fit in. So as the first point states that the foundation of an enterprise risk management is typically based on your COSO model, the 3 lines of defense. So here at our end, the first line of defense are all the functional activities. So it can be investment, it can be fund management, it can be operations, it will be marketing, HR, finance, all are in the first line of defense. The second line of defense typically is the risk management function, the compliance function. And the third line of defense in our setup is the internal audit or the external agency who gives us the assurance that all our activities, functions, processes are functioning in the desired manner. So risk management enterprise framework, basically the framework, the way we set it up is with various committees. Now the committees will be of executives or the committees will be of the board. So we typically have risk management committees of executives where the entire senior management functional heads are part of that committee. And this is conducted on a monthly basis, basically at our end, wherein any risk or any outlier which from our tracking experience which comes up, here we actually would take up with that functional head and ensure that the detailed RCSA and the mitigation has been done. Similarly, the minutes of these executive committees are also placed to the risk management committee of the board, and any emerging risk or any outliers will be discussed in the risk management committee of the board on a quarterly basis. So this is the framework that we follow. So technically you have the risk management committee of the board on the top. You would have the risk management committee of executives below that. And then you have the members, which is the CEO and all the functional heads of the asset management company, all forming part in the risk management committee of executives. Typically, the way we do it, we technically map what is our capability in terms of risk intelligence in our organization, and then we design a map that where we want to go maybe 1 year ahead, 2 year ahead, 5 year ahead. Technically, it moves from a nascent risk intelligent organization to a risk intelligent mature level kind of thing. So we track this journey every time. Once in a year we present it to the board saying where we are and what more needs to be done. So that is one important part of the framework. Then obviously, as I said, there is a governance structure wherein we set the tone at the top. So typically we have board committees, we have management committees, and we have various policies which we prepare in terms of addressing various processes at the policy level. And from the policies, obviously, you will have processes, procedures, standard operating processes which fall out of it. But policies usually are at a 30,000 feet kind of thing, wherein we address all the regulatory requirements, all management requirements, risk mitigants, and so on and so forth. All are internal, external, all are part of the policies that we have, which are reviewed on an annual basis and approved by the respective boards. So technically, a mutual fund will have two boards. One is board of the asset management company, and second is the board of trustees. So these are the two boards which a typical mutual fund is set up, for your understanding. Yeah, Kalpita. Okay, audits, again, as I said, the third line of defense is the independent audit. We have regulatory inspections, we have external audits, we have IFC testing, and so on and so forth. Assurances being given to the board and the audit committee by the independent assurance framework. So anything apart from that, wherever there is a residual risk, now to cover that beyond our mitigants, we then have insurance policies which we underwrite or we purchase. So typically we have an investment management insurance at all mutual fund ends, which typically covers your third party fraud, errors, everything. It's a composite kind of a policy which combines fraud risk, error omission, directors and officers. All this has been covered in that one unique policy. So each mutual fund or an asset management company would have taken an insurance policy for anything which goes beyond the checks, controls, balances on every process. Yeah. So now just to come to enterprise risk management and operational risk management. Yeah, Kalpita. So basically, I think from a theoretical perspective, an ERM setup is nothing but identification and evaluation of risk and control. So we have institutionalized the ERM framework at our end. We have basically identified various risks across all functions, and we have detailed risk registers which run into few hundreds of risks, maybe around 584 precisely is what the last register had. Then we have mapped all these into a heat map. So typically, after your controls been put in, checks been put in, what is the residual risk and what is that heat map of it? So is it extreme? So it's a 4x4 or 5x5 kind of a matrix, which typically tells you where does that particular risk fit in. Then subsequently, we do RCSA every on an annual basis across all processes and all the risks. And then we again regenerate the heat map and see that whether a particular risk has moved levels, whether from medium to high or vice versa, high to medium. That tells us whether our controls, our checks and balances all are in place. So this is a continuous process. So we have our risk register, heat maps, RCSA, and based on that, we keep on reiterating or changing or adding, deleting the risk registers and the heat map. Then the next framework is obviously of the internal control framework, which is entity level controls, process level controls. Control testing is basically done for design and its effectiveness. And the most important thing is also fraud risk management framework, wherein we have policies, we have incident reporting. So all these things are part and parcel of this internal control framework. So unless you have a framework and you have clearly defined who is to do what and what are the acceptable tolerant limits, what is your risk matrix basically. So all these things form part of the framework basis. So unless once you have this, then is when you start tracking and monitoring vis-a-vis this framework. Yeah, Kalpita. So that's where I mentioned that monitoring and reporting of key risks. So typically the reporting is one first at the executive committee, risk management, risk committee of executives, then to the risk management committee of board, and then subsequently it's been also put to the board of directors of the AMC as well as the trustees. So this is the monitoring and reporting of key risks. Then it just doesn't, the framework, unless you have an awareness or a culture building. Risk is more about a culture, and as I said, as in India, typically amber means you speed up rather than slow down. So we keep on telling people that we have various online modules which we have developed in-house, in terms of which are mandatory for each and every employee of Nippon India Asset Management, in terms of undergoing that training. We keep a track who has taken it, who has not taken it. Then we also have typically small quizzes at the end of these computer-based training. So this is what we have in terms of risk awareness, culture building. Apart from that, we also keep on sending phishing mails and so on and so forth from a cyber risk and information security perspective to the entire staff of the asset management company. Then, as I said, these are the audits or the independent assurance which we have. We have internal audits, we have system audits as well, done by the internal auditors or an external agency. Every year we have a regulatory SEBI inspection, which is mandatory typically, which is they have a checklist, and there are external chartered accountancy firms which are appointed by SEBI, and they are deputed to do this annual sort of inspection. So currently it is annual for operational aspects, and it is 6 monthly for a systems audit kind of thing. So these are the audits, as I said, and any other audit or external thing that would come up. Risk transfer, again, I said policies are there. Then we have fiduciary responsibilities. So typically in all our mutual fund schemes, we end up investing into stocks or debt securities. So we have these fiduciary responsibilities of proxy voting. So we typically see that whatever resolutions the underlying companies in which we have invested on your behalf or the unit holders behalf, whether those resolutions are in the interest of our unit holders. So accordingly, proxy voting has been done. The decisions of all these proxy votings are being put up at our website, and anyone, a unit holder, typically would be able to see whether what the mutual fund has voted and whether that voting is in the interest of the unit holders. Similarly, we also have stewardship responsibilities, wherein we have a policy of stewardship. We try and see whether we are, ensuring compliance to the stewardship. Though this is a new concept in India, but technically, under the stewardship responsibility, we can challenge the management and even actually lead to a change in management or change in ownership if we find that due to which it is detrimental to the interest of our unit holders. So this is the overall, I think, the governance and the framework piece. A board meeting, obviously, because yeah. Any question? So apart from that, because we have to ensure compliances to various frameworks, policies, the risk management plays a major role in terms of, leading the board of directors meetings, both at AMC as well as trustee company, in terms of ensuring and assuring various compliances to various regulations, policies, and practices. So this was all related to the governance framework, which is the bedrock of risk management in mutual fund. Now I'll just take give you a quick glimpse of what kind of investment related risk management that we do. Yeah. So basically, I think the primary objective of anyone investing into mutual fund is for a performance and a performance of that particular scheme vis-a-vis its benchmark. So for us, this chart for every scheme is very important. So basically what have been the performances of the portfolio vis-a-vis the benchmark. Maybe this is a hypothetical thing wherein performance can be positive as well as it can be negative. The benchmark can give you negative returns and so can the portfolio. Ideally, we would expect that a portfolio should be giving return irrespective of what the benchmark gives, but it's not so, because we obviously, the portfolios are benchmarked and are replicated in some form and fashion with the benchmark. So typically we can either beat a benchmark. So if you see on the positive side, I think the benchmarks have beaten us. But on the negative side, in some of the instances, we have fallen, we have given lesser negative returns than the benchmark. That's what we call outperformance, though it's negative. But this is a very important slide and we track it for each and every scheme on a monthly basis. And then we present it to various committees. So we have an investment committee, we have various other committees, risk management committee. So this has also been taken to the risk management of the executives, of the board, and even in the board, this has been presented. Yeah, Kalpita. So what is this performance? Now, from this performance, we also, from a risk management perspective, we conduct the attribution analysis. So this is nothing but basically you try and decipher the performance of your portfolio from basically the effects of allocation and stock picking. Now, these are two attributes against which your performance is broken. So typically, if effects of allocation means if in a benchmark, particularly the allocation to a particular sector, I would say IT, if it is allocation to IT is maybe 30% in the entire benchmark, the weightage. Now we would have allocated 25% or 35%. So it is positive, negative. And due to that over allocation or under allocation, what is the impact on the portfolio returns? So because of that, whether it is contributed positively or negatively. So in short, if I was over allocated to IT vis-a-vis the benchmark and IT has done well, then obviously it would relate into positive performance. But if I have over allocated and the sector has underperformed, then it will show that with this over allocation, in fact, it has impacted your performance. So similarly, again, stock picking is what kind of stocks which are there in under a particular sector in that space. Now, whether we have changed the allocation, have we selected some other stock in that particular industry? So what is the impact of that? So this basically shows us what are the qualities of each and every portfolio manager, how is he allocating, how is he performing vis-a-vis the benchmark. So of which, how many of his allocation decisions have been right, wrong, how many of his stock picking decisions have been right, wrong. So this helps us to analyze the portfolio performance and then suggest various corrective actions, or the portfolio managers, the CIO, the chief investment officers, they look at it and then they change the portfolio strategies, obviously considering the macro and the micro factors in that particular stock, industry and sector. Then on the next slide, you will see we also track typically the sector weightages in terms of our funds, where all vis-a-vis the benchmark. So a negative number will say, are we under are we underexposed or are we overexposed? And so typically you will say a minus figure in, suppose large cap fund minus 2.08 is an under allocation to telecom vis-a-vis benchmark, whereas we are over allocated to you can say industrials. So we are industrial skewed these portfolios vis-a-vis the benchmark. So accordingly, we have our thresholds and things, how much an outlier can one be in a particular portfolio or sector weightage. And then accordingly, corrective actions have been taken. Now, this allocation is when we actually initially buy it, but subsequently if the markets have been favorable, these are passive kind of attributes which keep on creeping into the portfolio, wherein under industrial, suppose when I took into some maybe an engineering company, the prices have doubled, then this industrial allocation automatically will be higher. So that's where the portfolio managers take a decision in terms of rebalancing the portfolio to ensure that you either book your profits or losses or leave it unrealized. So this is one way of managing the risk in a particular portfolio. So one is this sector. On your next slide, you will have, typically we do style factor analysis. So our portfolios are typically the underlying investing companies, whether they are beta sensitive, they are earning quality sensitive. Yeah, so this is the style factor. So these are roughly 14 style factors typically, which will tell you whether the portfolio is tilted to a momentum kind of a stock or a value kind of stock. And we have our thresholds wherein we say that it should be within these thresholds in order to ensure that we deliver a consistent performance to our unit holders. We don't want in one month or one quarter or one half year or an annual, we have supernatural extraordinary performance, and on the next it is not. So typically all these things from a risk management perspective ensure a check and balance on the portfolio managers and ensure that we deliver a consistent kind of a performance. So these are a few of those matrices or risk management measures that we take. The next slides will show you various ratios like Sharpe ratio, information, Jensen, R squared. Now these are all the risk adjusted ratios. Some will show you the consistency of the performance of a fund manager vis-a-vis the benchmarks and so on and so forth. So I will not touch on basically the theoretical aspect of these ratios, but if anyone has any questions, I can take them at the end of the session. So as we say, Sharpe ratio, we track information, Jensen, R squared ratio. On the next slides, you will again have a beta of the portfolio, tracking errors, volatility, VAR, value at risk at a particular confidence level, and so on and so forth. So these are everything. It's a culmination. This is part of science. And obviously the portfolio managers also have an art in terms of identifying a stock or a security, which they ensure that it is in their portfolio or not in their portfolio. So this is the entire risk management framework from an equity perspective. Subsequently, in addition, for the fixed income, you obviously, one more risk which is there on the next slide is the liquidity risk. So typically, liquidity risk is there in both equity as well as fixed income. So typically, we try and see what is the top 3 schemes beyond 10 days liquidity. So we see what percentage of stocks are liquid, illiquid. So we try and take 3 months average. What are the volumes? Now is the holding, how many days it will take typically for a scheme to liquidate beyond 10 days and so on and so forth. So here you may see it is 70% is illiquid. That means it will take more than 10 days. It's not illiquid without impacting the price, okay, without a price impact. Now this is the various analysis that we do in terms of liquidity risk. Subsequent slide will tell you about credit risk. Now credit risk is more related to the fixed income portfolio, credit risk, and obviously the interest rate risk. So basically for credit risk, from a risk management perspective, all of you all would be well aware that we need to have a financial analysis. So basically you will have ratio analysis, you will have trend analysis, you will have projections, you will do various other, looking at the rating rationals is what we do. Various rating agencies issue rating rationals for particular securities or particular issuers. So there are changes, upgrades, downgrades, there are negative outlooks, positive outlooks. So that entire study is being done along with our internal analysis and meeting with these issuer management and trying to understand what's happening in these companies. So market intelligence is one thing. Then we also have a debt portfolio rating wise category in terms of we have certain thresholds, how much of the percentage of the portfolio should be AAA rated, AA rated, single A rated, and so on and so forth. Then for managing credit risk, obviously we closely track the upgrades, downgrades, and we also have an internal team which does the credit review across portfolios. So in all, this is what is being done to ensure that there is minimal of credit risk in any of our portfolios. The next risk which we track is the interest rate risk. Typically, it is nothing but in terms of whenever your interest rates are rising, your prices of the securities are falling because the expected returns are rising and hence the price will fall. So that is where the interest rate risk. So typically, the way we mitigate or the way we track is you have a duration management. Typically, we look at the macula duration of portfolio securities, and then accordingly, the portfolio manager considering the interest rate view and the action. Typically, it's mostly forward looking. So the investment teams, the CIOs will have a call in terms of which way the interest rates will move. Accordingly, they manage either the duration of the portfolio and the quality of the portfolio. So higher rated a security, lesser it will be impacted, and vis-a-vis. So if we anticipate that the interest rates are going to move southward, then obviously durations are increased, lesser, the portfolio quality can get diluted to some extent. So all these things are the tools which the investment team and the risk management team jointly look at, monitor, and have acceptable thresholds across all portfolios. Yeah, I think. So this was, I think, more on the investment related risk. Now, just a quick glance on the information and cyber security risk related management, what happens in an asset management company. So typically we have digital assets and initiatives which are transaction enabled. If you visit our websites, you visit our investment apps, you will see that not only information is there, but you also have external interfaces. So this all digital assets then need to be, VAPT, vulnerability assessment, penetration testing has to be done while launching, and if any change is to be done. We have other data leakage prevention policies, a DLP kind of incident monitoring, wherein information is not moved out of the company. We have to fingerprint various documents and identify keywords in that just to prevent a particular thing being sent out. On a daily basis, we have SOC-SIM kind of a tracking wherein we track whether what kind of threats our digital assets have. So we have a full-time chief investment security officer reporting into the chief risk officer, and who does all these activities of identifying on a daily basis, real time, what have been the attacks, threats, how many of them have been successful, unsuccessful. Then we already have identity and access management things, so wherein it gets reviewed. It also gets reviewed by the internal auditor, the external auditors, and flagged off if there are any issues which may lead to any cyber related incident. Obviously, then there is also reporting of the cyber related to the board, to also the regulator. So all these things are from an information security and perspective. Apart from this, we also do we have a business continuity plan policy. We have DR drills which we do in terms of seeing whether all our assets are accessible from office, outside office. And in fact, COVID was that period of 2 years which actually was the real DR and DCP kind of test to see how robust are our systems. And I think not even a single day for Nippon we had a breakdown. In fact, we came out very clean. No single day was hampered, not even a single hour. And that's what where we stand in terms of our information security and cyber security related aspects. Yeah, Kalpita. So Yeah, I think this is from my end basically. So initially I showed you risk management in mutual fund industry as red. Then I said it is all about managing amber. And by doing all these processes, your thank you for your time is green. So I think this is how in short I have explained you what all is there in risk management in the mutual fund industry. Yeah, thanks.
Uh, Thank you, Milind. Thank you for such an insightful technical discussion specifically for risk management in mutual fund industry. While we will take up the questions that will come up post 15 minutes of discussions on the internal audit side. So Milind has definitely touched upon the technical aspect, how what is the objective at Nippon mutual fund for the risk management. I will also just quickly take time in terms of we've seen from an industry perspective, but now let's look at it from an internal audit perspective and also touch upon the new risk management circular that is completely the thing in the entire mutual fund industry. So I'll just touch upon the components. Now, while we all know that, I'll just share some slides. So, now, what is the objective of the risk management as far as the mutual fund is concerned? So, the main objective as far as risk management in mutual fund is concerned is definitely high standard of services to the clients, exercise utmost due diligence as far as dealing with the client's money, ensure proper care in their operations, see that the operations are timely and as per the regulations, and utmost important is protecting the interest of the investors. These are the four broad objectives from a risk management perspective. Now, over this year, SEBI, the regulator, has come out with a lot of risk management measures for the mutual fund industry. And about last year, September 2021, it came out with a consolidated, a newer framework for risk management for the mutual fund players. This, like the next 2-3 slides, covers into aspects of what are the critical elements and the components as far as risk management are concerned. The circular talks about certain around 8 to 10 critical aspects that needs to be covered as far as risk management is concerned. So definitely the circular talks about having an overarching risk management policy, which covers your governance structures around risk management. As Milind mentioned that, each mutual fund has a proper governance structure. It was always there in the mutual fund industry, but this circular kind of has touched upon and reiterated the governance structure. It has specifically called out roles and responsibilities and delegation of power at each level. So it talks about what are the risk management roles and responsibility, right from the fund managers to the CEO, to the various committees, to chief risk officer, as well as what are the roles of the internal auditors. From a risk appetite definitely it was there. It was much more focused on the investment side. However, now coming this circular, it talks about 13 categories of risk. It not only covers the investment aspect, it covers broad aspects in terms of the entity level risk also. So each of the mutual fund has to define the risk appetite across these 13 categories of risk, monitor it on a regular frequency, report any outliers, have an internal targeted risk level for each risk categories. Having documented risk registers across each risk category, right from investment, credit, liquidity, governance, to your marketing, operational, HR, all this needs to be documented in the form of a risk registers. Once that has been done, it calls for a functional RCSA. RCSA is risk and control self-assessment, where each of the risk owners will review the risk and the controls, will see whether they are functioning effectively, and will give out a confirmations as well as also give out an early warning signals in terms of in case if we are near to deviating any kind of a risk. The circular also mentions about monitoring framework. So as Milind mentioned in his conversation, that there are 3 lines of defense. Definitely it possesses additional responsibility on the risk officer as well as on the internal auditor. The next one is on the reporting framework. There is the mutual fund also has to report specifically on the whether to the committees in terms of whether there is appetite. They'll have to monitor and report. Also, there is a half-yearly reporting that will go to SEBI on the entire risk management framework. From an internal audit, now what are we as internal auditors looking as far as risk management is concerned? Because the circular specifically says that there needs to be a dedicated internal auditor at AMC as well as a scheme level for the risk management who will review whether the circular has been implemented correctly or not, it is functioning effectively or not, and provide an internal audit report. So definitely it says that, all the internal policies, there are around, if we look at the SEBI requirement, there are around 40 policies and processes which have been quoted in the circular. We as an internal auditor need to look at whether these policies are in place, whether those are comprehensive and have been implemented effectively throughout the year. The new concept of non-compliance rate, which is nothing but in terms of how much is the compliance, how much are the compliances ensured across mutual fund and each category of the risk, needs to be computed and provided in the internal audit reports. So this is specifically which they have asked internal auditors to quote in each and every internal audit that they do across mutual fund. And also the internal auditors have to submit the report to the audit committee. Now, once this everything has been done, the internal auditors have also been tasked to provide a rectification index. Rectification index is in terms of all the observations that are been highlighted in the past, whether what is the level of rectification that has been done. So audit committee in their quarterly and reports need to look at this rectification index, whether it is on the positive side, whether it is going negative or whether it is stagnant, and appropriate action needs to be taken. Now, as far as internal audit is concerned, for the risk management, it is more of we'll have to audit the risk officer. So in terms of what are the monitoring activities, etc., that have been put up by the mutual fund, in terms of what are the process adopted by the CRO to ensure compliance to the policy. While as an internal auditor, we look at the transactions any which ways from a mutual fund internal audit perspective. For internal audit of risk management needs to be focused more on the monitoring natures. We'll have to audit the second line. We have to see whether the risk appetites have been appropriately reviewed. They have been changed depending on the nuances in the industry, and whether they have been appropriately reported. As an internal auditors, we need to look at risk management committees and its functioning, whether the agenda has been appropriate, whether all the reporting has been has been done to the risk management committee, as also the delegation of powers for risk management needs to be reviewed. The important aspects in terms of control self-assessment that was mentioned in the earlier slide needs to be verified, whether the management is actually reviewing the controls, or whether are they doing self-assessment, what are the steps that have been taken to ensure that any identified issue has been appropriately dealt with or any action has been taken. Existence of policies at scheme and AMC specific risk needs to be reviewed. the important aspect that the circular talks about, and Milind also mentioned in, is that, what are the early warning signals? Are we reviewing? Do we have tools and processes in place which will highlight the early warning signals? Have we, designed what needs to be reviewed from an early warning specifically, rather than getting into a non-compliance? Have we established the early warning signals? Are those reviewed by the risk officers? Are those presented to the risk committee and discussed and deliberated in the committees? We need to look at those aspects. Definitely risk reporting by the CRO, the CEOs on a monthly basis needs to be covered. And as also the reporting to the half-yearly reporting to the SEBI in terms of the risk management framework compliances that needs to be looked at. So this specifically, why I'm saying, is more from an internal auditor, what internal auditors should look at. These are the broad aspects. Definitely internal auditors would get into details of each of these. Important aspect that has come up for internal auditors in this thing is the non-compliance rate. Now, there are no specific guidelines as far as internal audit non-compliance rate are concerned, and we have to derive our own methodology aligned to the internal audit head and the audit committee at the mutual fund. But the two aspects that needs to be kept into mind is in terms of the severity of a specific process that gets covered, as well as what are the error rates observed during the internal audit process that needs to be specifically considered when we calculate the non-compliance rate. As well as this non-compliance rate needs to be communicated in all the internal audit reports. And as I mentioned, the rectification index needs to come out specifically as and when we do when we revisit that specific area in the subsequent quarter. So this is specifically what an internal auditor, from an internal audit perspective, Milind, others happy to take add if you can add anything from a management perspective on the risk management circular, and also happy to take any further questions on this. Thank you.
Yeah, I think Kalpita, I think this circular came in recently, which was a revision after almost 10 to 12 years of the previous circular. As you rightly pointed out, but this one major thing that this risk circular has done is actually it has empowered the chief risk officer in terms of managing the risk across the organization, and maybe an enterprise-wide risk framework would help, which we have already implemented, and we have done a lot of things. So there, I think we were way ahead of the regulations.
Yeah.
Plus, one more thing that it really does is it has segregated the risk responsibility. So typically, previously, chief risk officer would have been responsible for all risks that are in the organization. Now this circular says that for investment related risk, it is the chief investment officer and who is solely responsible, and each functional head is responsible for the respective risks that are emanating from their functions and the activities that they carry. So now this circular talks about a self-declaration by the respective CXO to the CRO, and CRO will collate it and then report it to the CEO and to the board, and he then uses his discretion and identification in terms of what needs to be reported, what needs to be monitored. So now it has given a clear-cut, responsibility, accountability kind of a framework as well, apart from the checks and balances that the regulator has imposed.
Yeah. And it has made the entire risk management more structured. Definitely roles and responsibility are very much clear. Most of it also goes into each and every KRAs. They have said that you will have to have those KPIs defined, and risk management needs to form part of the KRAs of each of the risk owners. So it has specifically called out, and definitely there are a lot of reportings and there are a lot of preventive aspects that have been cast through these circulars, rather than having a detective kind of monitoring mechanisms. So yes, the circular has, and almost like, this circular has been implemented across mutual fund. And now the key aspect is, while the design aspect has already been taken care of by all the mutual fund, the key aspect is how whether it is implemented and functioning effectively is what from an internal auditor's role is to verify.
Right. Yeah, I think.
Yeah. I guess if there are any questions, we would be happy to answer. Any clarifications, anything, any additional aspect that you all want us to discuss, happy to take those. So the first, there's a question which says that, is there a set of guidelines to implement the SEBI circular? So, Milind, you want to take that, or should I?
No, I think the circular was there. The guidelines, what I think got implemented was, I think the industry at our AMFI level, we appointed a consultant, an audit firm, KPMG, who actually helped the industry in terms of, what policies should be there, the wordings of those policies, drafting of policies, setting up of committees. But typically certain AMCs even didn't have a chief risk officer as a designation been given. So all those do's and don'ts and the mandatory things was actually being decided, and then it got uniformly implemented across all the mutual funds, and the confirmation to the regulator was given. So those were the guidelines that were issued, and various sessions with chief risk officers and various people were taken by KPMG.
Yeah. And also, like, if we can touch upon specifically what are the tools, etc., that some of the mutual funds have implemented. Milind, as far as you mentioned, that we do attribution analysis, there are early warning signals, etc. So what kind of tools can be are implemented or are available in the market?
There are few GRC softwares, governance, risk compliance kind of things, which in which you can track all your activities. It's an automated process wherein each function has to enter its activities, controls, and so on and so forth. And all these RCSA, which typically everything can be tracked and monitored in that. So that is from a framework and governance perspective. As I moved into the investment part, I think there are various modules, like you have an MSCI BARA, you may have FactSet from Reuters. So there are various tools, even Bloomberg to majority of the extent can decipher your portfolio and give you a holistic view from a performance as well as from a risk management perspective. So these are all tools which are available in the market, and various AMCs use various combination of it. So we have one more tool which is Valuefy. So technically, for attribution at a domestic level, Valuefy is very informative. At a global macro level, typically MSCI, BARA, and various of such tools are being used. So some are effective in fixed income, some are effective on the equity space, some are on the commodity space. So each mutual fund has implemented a suitable kind of a tool, which is which is there. So there is no one set or a but it is a combination of some are in-house, some are done on spreadsheets, some are done on with the help of the tools. I think we have bigger portfolios, a lot of a huge asset management under the our management. So we usually rely on all these advanced tools. In fact, Nippon was the anchor client for MSCI before it came to India. We were the ones who, maybe around 2015 odd years back, when we got MSCI to India.
Yeah, that's it. And from a risk management perspective, also, as we mentioned, the risk registers, the RCSA, right? For that also, some of the mutual funds have started using tools like, where each of the risk owners will provide their confirmation on the risk control self-assessment through the tool, and the risk officer will get the chief risk officer will get a dashboards. And those dashboards would be reviewed along with respective owners, functional owners, and the outliers. Definitely a dashboard will convert into a report, and it will be presented to the various risk committees, so that the top level gets an overall view in terms of where we stand, what are the top risks. It was there in mutual fund as far as ERM was concerned, enterprise risk management. However, operational risk management, your regulatory risk management, all these aspects have been specifically covered in the recently issued circular. And I guess mutual funds are now gearing up to work on those kind of dashboards that will provide a bird's eye view to the management as well as to the risk committee on the entire 13 categories of the risk that have been mentioned. There's a question, asks like, how different is this circular from the previously issued circulars? So specifically, as we mentioned, that this circular clearly articulates the roles and responsibility, clearly articulates what are the things that needs to be one covered, and also from a documentation perspective, it has come out with a lot of clarity, what needs to go into the policy, what needs to go into the process, what needs to be reviewed on a regular frequency. While this was there, but then there is a structure now to this.
Yeah. Any other questions?
So there is a question which talks about now this entire mutual fund now more on is going into a digital mode. Right. So now what are the newer risk, or what are the newer aspects that needs to be considered from a digital risk perspective? Because almost 70 to 80%, almost more than that, some of the mutual funds have more than almost 90% transactions which are coming digital through online, through apps, through any other digital, yeah. And the manual thing is completely on a reduction side. So now what is it that needs to be specifically consider? Any insights on the digital side?
On the digital side, the regulator has come with that two-factor authentication and email and mobile verification, wherein it's mandatory for any transaction which is done online across platforms or across digital assets have to have a two-factor authentication. So one is the password, second is we do send a OTP on the registered email ID as well as the registered mobile number. There were a few challenges which I think the industry did tackle. So typically, if you're coming directly on a mutual fund asset, then we would send you the OTP on your registered email ID and your mobile number, which was pretty easy. But typically, we have channels and exchanges through which it comes. So typically, it would come through a distributor or maybe a digital partner like iDirect or any other. So there we had observed that the registered email ID and phone number with that entity may not match with what the mutual fund RTAs would have. So the first exercise that we did was to basically match that data, and it is the RTA's data which is final. So accordingly, through requests from the investors which the channel partners took, and then they over corrected the data. So now any email address as well as mobile number now match with the channel partner or the distribution platform and the mutual fund RTA, which is one risk measurement mitigant basically. So now unless someone has access to your emails or your mobile, now it is at least bit sacrosanct in terms of to avoid any cyber related frauds or risks.
Um, uh, then also there are certain aspects where we because mutual funds are heavily engaging with third parties third parties in terms of definitely the RTA and the custodians. There are two main, and now again from a commodity perspective also we are getting more into ETFs, gold, silver aspects. So from a third party risk perspective, any insights, or because definitely the risk management, there are SLAs which have been defined, there are monitoring mechanisms. Is anything changed or in the recent past because of the circular from a third party risk perspective?
One is, I think we have outsourcing policies being clearly defined, and we have various agreements and SLAs being defined with all the outsource partners. So typically mutual fund industry, the major outsourcing partner is the RTAs, the fund accounting, and maybe the custodian. And to some extent, you may have some call center related services and so on and so forth. So these are the major things which is being outsourced. So we obviously have various, we have a policy which is board approved. We typically also have all the SLAs and agreements being reviewed on an annual basis and also tracked. Now with the new risk management circular, I think it is mandatory, and they've made it that you also need to have a regular review process. You have to document it and present it to the forward it to the chief risk officer, as well as present it to the risk committee of executives, as well as board for AMC, as well as for the schemes. So this has helped that it's into more structured. It's not that it was not done, but now it is more structured and documented and been reviewed at various levels, whereas it was previously only reviewed at the functional level. But now you have various other levels, like various committees which will also review. And typically, if any incident is there happens, then obviously you can backtrack it with certain declarations and things that the functional heads give. So it is with that.
And also this risk, this third party, since they handle so much of data, voluminous data, like mutual fund is one industry which deals with volumes and volumes of data. And definitely RTA supports mutual funds on this. What I understand is there are certain tools in terms of analytics, etc. Those are embedded into the systems, which highlights the outliers, and those outliers are then reviewed. So are there I remember some of the mutual funds have already implemented those analytical tools that runs on a day-to-day basis. Means it's not an audit, but it runs along with the day-to-day operations of the business, and it gives out outliers. Like, do we see much of the outliers, or it is I know that Nippon runs a lot of analytics on the third party data that has been handled by the third parties. So how is it does it gives out outliers? Is it sufficient, or is it it's still if you can provide some insights on those analytics?
So Kalpita, usually if you look at the transaction volume, I think previously it was all physical mode of transactions. Okay. So there the percentage of errors or the probability of errors was pretty high. Data entry itself was a major challenge, wherein you are going to enter 100 odd fields in terms of from the form, and one wrong entry may lead to some issue somewhere. I think now with a lot of almost 60 to 70% of the transactions are digital, and digital means someone else would have already done the basic entry. So basically your account opening and transaction is being segregated in a digital kind of an environment. But whereas for physical, your account opening and transaction is clubbed. That's where the risk was. So it's been mitigated with the industry moving mostly to digital sort of transactions. And that is thanks to the pandemic, because a lot of guys actually were forced to move on to a digital kind of thing. And with this two-factor authentication and so on and so forth, I think it is a strong and a robust kind of a setup which has already been there. So which take care of whatever you have been raising.
Yeah. And from an internal audit perspective, newer areas have been emerging from a review perspective as far as mutual fund. Like, definitely digital is one of the key things that now, because earlier it was getting covered as part of transaction review, but digital, the functional aspects of backend, like, in terms of what is shown to the user on the front end of the website or any app, that also needs to be specifically covered from an internal audit perspective. It is a mix of both IT as well as the operational audit,
Right.
but definitely the auditors need to have those specific skill set to review this aspect. Digital is definitely the interfaces, the back-end masters, the time
Yeah.
and scalability, because there are a lot of investor complaints that comes out saying that we are not able to log into the website. The website is not providing us with
No.
accurate NAV.
Yeah.
This type of issues are on the increasing end now because of this entire thing
Right.
going digital.
Right.
We've seen that newer areas from an internal audits are also been coming up to look at this end to end may not necessarily get covered under the IT audits or reviews. And definitely time issues, accuracy issues are coming up because there are these digital sites of mutual funds are interfaced with the back end of a third parties,
Right.
the RTAs. So
Right.
we need to specifically focus from internal audit rather than the regular transactional audit, focus more on this aspect.
Sure. I think there
uh,
are a few questions on the conduct risk and so on and so forth, right? So
yeah.
doing that. Basically, I think SEBI had issued one more circular on the conduct risk code of conduct, and typically for the investment fraternity. So this is again code of conduct. So it said that all the calls or any mode of communication that the investment team would have, and anyone who is looking at a will have to do it either through a recorded line. Okay. Now, this was one thing was a challenge wherein during pandemic and the circular was issued before that. So technically, I think most of the mutual funds, including ours, then we had, because the one was the fund managers or the dealing team were given special passes under the regulatory framework wherein they were allowed to travel with a sticker on their vehicle or wherever that it is essential service. Apart from that, I think we also gave them mobile handsets which were recorded. So all these kind of things have been done in terms of all their communication during market hours, whether it is personal or official, it gets recorded. We also have a platform that is Teams. So instead of Zoom, we use Microsoft Teams. So we have a capability and we have institutionalized that wherever a fund management, a research or dealer comes on to a particular call, internal, external during market hours, the recording automatically starts and it gets recorded and then stored. Apart from that, we also have a quarterly declaration to be taken from all the investment teams stating that they have adhered to the code of conduct and so on and so forth. So that is the way it's more of a declaration based and some few of a tracking. So we typically would barge into the recorded calls, understand what's happening on a random basis. And so is also being done by our internal auditors, that is Deloitte, right?
There's a question in terms of work from home and how SEBI rules are those friendly?
So I think previously through Amphi and things we had said that okay, work from home was, in fact it was initiated, but now with the things coming to normal, SEBI, in fact Amphi has issued a guideline stating that all investment, research, dealing, all activities will be done from the office premises on all working days, and risk management, compliance, and operations, who all uh, are exposed to the portfolio details and so on and so forth will have to work from office. I think that is what it is. For others, other functions, maybe an HR and accounts or somewhere, I think there they have not mentioned any particular work from home policy. But for these activities and these functions, it is mentioned that it will be only carried out of the registered offices of the mutual fund and to the dealing rooms only.
There's another question which says that what is meant by benchmark as mentioned in the risk management policy?
So benchmark is nothing but typically it's a set of ideal portfolio that we want to benchmark against, and it may differ from AMC to AMC. Typically, we usually takes maybe either we take BSE 500 or Sensex or Nifty or mid cap. So it depends on what is the mandate of the portfolio and what is the relevant benchmark. So that is the benchmark, and then the portfolio is compared. Portfolio returns are compared with the returns of the benchmark portfolio, and then attribution analysis and all the risk matrices or performance ratios are being run on it, and then we see whether have we outperformed the benchmark or underperformed the benchmark. So that is a ballpark figure that technically an unit holder can expect, but it is not assured that it will get delivered. Either we over deliver or we can under deliver it.
There's this question on the governance structure. So on the governance structure, as I mentioned that, there are 3 lines of defense which are specifically defined. There are specific roles and responsibility on risk management, which are costed on respective owners, right? It also talks about what is roles and responsibility of risk management of the CEOs, the trustees, as chief risk officer, fund managers, operations. So it's specifically what is the roles and responsibility as far as technology officer is concerned. So this circulars clearly laid down the roles and responsibilities, which now also is available on the website of each and every mutual funds, and also forming part of the KRAs of each of the owners.
Right.
In terms of newer areas, I just wanted to take a minute in terms of highlighting the newer areas. As I was mentioning, the digital definitely is the key, newer area that has been in focus as far as internal audit is concerned. There are newer aspects in terms of revisiting the prudential limits, revisiting the systems which calculates your prudential limits. What are the softer limits that the mutual fund has defined? Because this also needs to be worked in tandem with the risk appetites which the mutual fund has defined across each risk category. Definitely, the third area which are in focus right now is the dealing room controls, just having a revisit to the dealing room, revisiting the personal trading policies, having some automation around, reviewing rather than going by just declarations provided by the key officials. So these specific aspects are the focus areas as far as internal audits are concerned. In terms of when will SEBI inspect this new regulation, so definitely
that will be part and parcel of their annual inspections.
So they've given time for implementation of 31st of March for actually working on this risk registers, RCSAs. Monitoring has already started around this. Definitely when the SEBI auditors will audit the year 22-23, they will look at this circular as part of their regular inspection for this year.
Right.
Yeah.
So anything else?
Any other question? How do we audit the risk appetite levels?
So I think as an auditor, you will tell us, right? Because we set the risk appetite levels. So basically, risk appetite levels, obviously, we set it looking at the past data. what are the aberrations, outliers, to what extent, look at the activities, the complexities that are there, and what is the residual risk out of it. Based on that, we will set the risk appetite. How you will audit is a question to you.
As also benchmark it across the same category, maybe same category size of mutual funds, and see whether the benchmark itself, which have been defined, appetite levels that have been defined, are appropriate, maybe enhanced, and are there any suggestions to this? Can we have an internal kind of an near kind of a, before even reaching the appetite, can we have a softer review around that? And important things is, what are the actions which have been taken in case if those appetite levels have been reached, or else reaching, maybe near to what is the action that is being taken, or else are we remaining are we not taking any actions, or is there anything that is holding us back to not to take those actions? That is something that gets reviewed in the risk committees, and that needs to be audited from an internal audit perspective. So from a risk perspective, yes, the risks needs to be specifically called out at a scheme level rather than having all schemes together. We have to monitor the risk at a scheme level, because different schemes have different nuances, different asset allocation, different objectives. The risk needs to be monitored at a scheme level. Definitely, there would be enterprise risk which are monitored at an overall level, and the risk which are pertaining to the enabling functions that are at an overall level. But scheme-specific risk would be specific to a particular scheme.
So, Kalpita, typically a scheme will obviously have two sides on its balance sheet. One is a liability and another is assets. So liabilities is the composition of investors. So typically any concentration of particular set of investors, and if they act then in correlation, then what kind of liquidity needs to be maintained in the portfolio. So all those things are being done in the mutual funds, which you would be aware. On the asset side, obviously, it is more to do with the securities that you buy. So rating, credit risk, liquidity, market risk, and all that is another set that gets tracked.
Are there any standard set of reports for the auditors? So answer is no. While there was a guidance which was provided by MFI for implementing the circular in terms of policy related contents, etc., there are no standard set of reports which are available for the auditors. Even the non-compliance rate that the auditors have to calculate, there are no guidance around it. And as I mentioned, it needs to be definitely looked from a severity of the specific process and sub-process. What is the severity level? Assign weightages to each of these sub-processes. And see the errors around that specific area. So if we say, suppose if we have 10 areas in a specific sub-process, say suppose investment, if we have 10 areas, we need to assign weightages across these areas and come out with a severity of that process. And if within that process, if we have an error, like on observation, that needs to be a product of both severity and error. That the simple non-compliance that needs to be provided in the internal audit reports. And this in non-compliance, as we understand, is not only for the risk management measures, it is across the entire operations of the mutual fund. So all the audit unit needs to be audited and provided with a non-compliance rate. What are the best practices as far as AMC level risk? So the circular also specifically calls out AMC specific risk, right from HR risk, which talks about succession planning, which talks about recruitment, which talks about the skill sets, It also talks about marketing at an AMC level. So various categories of AMC risk are specifically mentioned in the circulars. And all the mutual funds were anyways having the enterprise risk management framework, which had the entity level risk, which included like one of the aspect was conduct risk in that. So AMC, so best practices as far as AMC level risk, Milind, if you want to add, but these are the ones which are already been developed.
Right. So I think apart from your obviously IFC testing, so typically all the we've been a listed AMC, all LODR requirements as well as IFC and so on and so forth all apply to us, and we do take certification on all this. Basically, I think in an AMC, what would you have? Basically, you would have the management fee that we charge to these schemes, and technically the auditors will come and review whether have we followed the TER thresholds in terms of charging or the entire expenses. Is there any spillover of scheme expenses into the AMC? So that would be reviewed. Vice versa would be reviewed in these schemes, which is absolutely, I think that is the way it would go about it. Then, as you rightly said, HR, succession planning, your policies, your various code of conduct, guidelines, or there can be gifting policy and number of things which are there in AMC. Marketing, then marketing has been done for schemes, but there are SEBI guidelines in terms of what can be said, what cannot be said, who can say, who cannot say, what are the standard disclosures. And then we also have investor education awareness funds, which on an annual basis, okay, you keep 2 basis points of your PAT for that. You have CSR related compliances which you have to do. If you are listed, then like us, you have IPO proceeds, then have you used those utilization of IPO proceeds? We have related party disclosures, arm's length, and all that gets checked at the AMC level.
Yeah. So there's a question in terms of what are the various kind of reporting to be done. So there isn't any weekly reporting. Definitely there is a continuous monitoring that needs to happen on the various categories of risk. However, there is a monthly review by the CRO and reporting to the CEO. Definitely, there is any time which is kind of a instant, in case if the CRO comes across any early warning signal, it is not restricted to a period. It is as and when it happens, it needs to be reported immediately to the CEO as well as to the risk committees. There is quarterly reporting which will happen to the risk management committees. There is half-yearly reporting that will happen to the SEBI on this implementation of the risk management framework. So these are the reporting that is. There's also an overall question in terms of has the role of risk officer and internal auditor enhanced because of this entire new risk management circular?
I think it has enhanced, as I said. One is you have clearly segregated the responsibilities and duties. But anyway, I think from an overall enterprise-wide risk, CRO is still responsible. I think the way the CRO will monitor is through thresholds, risk appetite levels, RCSA, the heat maps, and so on and so forth. Previously, it was being monitored and kept at his end. With the new circular, all these parameters and matrices will have to be also presented to the CEO, and it has to be highlighted to see and look at any emerging risks which are there, plus also taken to the respective board of directors. Yeah. And in case if he feels that it is further to be reported to the regulator, he has the wherewithal to do it.
Yeah, definitely. Yeah, definitely. Definitely the CRO was responsible. But yeah, it has clearly articulated the rules of CRO, and he is now responsible for the regular reporting that happens, look at the early warning signals, ensure that each of the process owners, the roles and responsibilities that have been given have been actually been implemented. And as an internal auditor, the internal auditor's role has also enhanced to cover the risk management reviews on a regular basis. One question on the cyber risk, because like again, if we are going more online, is cyber risk definitely it is forming part of the top risk as far as mutual funds are concerned. But any specific measure that needs to be considered as far as cyber risk is concerned?
I think typically you need to have a SOC-SIM kind of a framework and a flesh and body kind of a setup that each AMC would need to track. If you have digital assets, even if you have a website, and if it is transaction enabled, if it is just an information one, maybe a lesser kind of risk we would run. But if it is a transaction enabled, typically we have implemented the SOC and SIM kind of infrastructure wherein we have people tracking the interactions, people who have hit our website, including someone from the darknet and so on and so forth. We have certain vendors who do assess it and give it to us in terms of we've also do the reputation kind of risk management, wherein we have engaged certain agencies who actually try and give us all those inputs wherever Nippon has been mentioned, good, bad. Based on that, someone sits and deciphers it. So at times we have seen that there have been certain flag offs wherein someone is portraying himself as Nippon and trying to collect money, trying to say that if you invest here, we will assure you a loan and so on and so forth. So all these things we look at it, and then those typical sites are being taken down. And if required, then we proceed legally against it. But till date, we have not required to go to that extent. I think we have been able to pull down those fraudulent websites and so on and so forth.
Yeah. I guess one last one on give me more details on non-compliance rate and how you have arrived. I need some examples. So yes, non-compliance rate, as we mentioned, that if I have to give examples of an example of an investment function. So say suppose there are 12 investment function will have a lot of sub processes like strategy, what is your investment strategy, your research, entire aspects around research reports, investment, the daily morning calls, investment objectives. It will have investment justifications, the entire aspects around dealing room. So it will have multiple sub processes. Now, if we see each of the sub process will carry a weight in terms of severity of that specific sub process. The internal auditors have to definitely cover all these processes as part of the internal audit review, and attaching the weight is is internal audit's prerogative, each of these area, like for example in having the prudential limits, adherence to the prudential limits is a SEBI requirement. So definitely it will carry a higher weightage in terms of entire scheme of this thing. Investment decision making, it will carry a higher weight. Now, once we attach weight to these specific sub areas within your work program, the internal audit work program, we have to review the samples and come out with the observations. Now, say suppose if we have observation in any of the high weightage area, like we have observations, say suppose in the justifications not been mentioned against the investment decision. So you put out weights and observations, say suppose it's a medium rated observation, you multiply that medium rated observation with the weightage for that specific department, for that specific audit unit, and you come out with a product. And that we have to look at it at an overall 100% out of 100%, how much is the non-compliance over there. So here is where we give a non-compliance rate as far as investment as an area is concerned. Most of the mutual fund works on the areas like RTA. How much is the error percent? How much is the non-compliance rate for that? For specific areas within the RTA audit, within the custody audits. So that's how our non-compliance rate. I can share one sample example separately with the group in terms of how we have arrived at the non-compliance rate. How often are risk registers updated? While the top mutual funds did had risk registers which were defined, they are updated online as and when the new circulars or the new processes are comes in. They're updated online by the respective owners. Online uses tools. So as far as I understand that as of now, the risk registers are maintained. Some very few mutual funds are using tools that maintain risk registers and also help them do the risk and control self-assessment. As I mentioned, that these tools gives out dashboards, etc. But at Nippon, I guess these are manually.
Yeah, these are on spreadsheets.
These are on spreadsheets. Are risk audits design or operations oriented? So risk audits are both design as well as operations oriented.
As well as effectiveness.
Yeah, because we have to ensure compliances to the regulatory requirements. So we have to do operations oriented reviews also. I guess, yes. So risk management is a continuous exercise, and there will be no end to this. Definitely the CROs as well as now then all the owners have to be reviewing it on a day-to-day basis, rather if I can say. Milind, any concluding comments on this?
No, as I said, the ambers will keep on changing, and the way people will react to a particular process or a set guideline will differ. So I think one is the anticipation from the risk management function, and second is any historical data that will show that people or someone has behaved in a particular manner. That is the way I think it needs to be mitigated. Look, risk always would be there, and you may not be able to mitigate or eradicate it completely. So you have a concept of residual risk, which technically you have to live with it, you have to accept it. Like market risk. Suppose the market tanks, no matter whatever measure and precaution you take, your returns of the portfolio will be impacted. Now, that is something which, if one has to have it as a residual risk, no matter what all tools, measures, style factor, sector, weightage, everything that we do, but if the market completely tanks, I think the mutual fund, any scheme performances will tank. But then the thing is how soon and how fast, if the market recovers, how aligned are we to it is the risk measure that one will have to look at. So I think my only request is to adhere to the traffic signal, and that is where I think the risk mitigant and the risk culture in an organization can be defined.
Yeah.
Thank you.
Thank you, Milind. Thank you. So I guess this is all from a risk management. Happy to take any offline questions, and also we will, this recording would be shared. We can share the sample slides with the group, with the IIA. Thank you. Ravi, Giri, any concluding remarks from your side?
Hello.
Ravi, can I do the concluding remarks?
Yeah, there's some summaries you have to give. Quite a bit of details out there.
Yeah, thank you. So first, let me thank Milind. It was a wonderful session. Thanks for sharing a lot of insights, right from the overall governance framework to run the risk management across the enterprise, and then moving on to investment related risk. I think it's very, there's a lot of insight that you shared in terms of the ratios that you're monitoring, the benchmarks that you are monitoring against. And this gave a lot of insight into how do you manage portfolio to a lot of our viewers and participants. I mean, enterprise risk management is a well-known subject. I think many of the internal auditors here would have touched upon it, in some point in their life, in their professional. But investment-related, risk management and what you monitor, how you benchmark, those are very key and important aspects that we learned today, which are very well differentiated. And of course, you also touched upon a lot of digital risk. Today, I think everything that we do encompasses digital risk. And right from cybersecurity is probably woven across any business platforms that we work on. And you rightly touched upon business continuity, disaster recoveries, and digital identity management and cyber security across infrastructure, your cloud infrastructure management. Today, a lot of work is getting done through third-party applications. So the application risk around managing those third parties, hosted environments, and so many risks are there. But these are, probably not, the business risk are, comes out of these, digital risk as well. They pose a risk to business. So very well, kind of articulated, Milind, and we think thanks a lot for, spending a good amount of time with us and sharing your practical experiences. And Kalpita, moderator, and thanks for hosting this as a moderator and bringing in the insight on SEBI regulations. I think there's a lot of regulatory changes that you spoke of, and these rules, regulations, and especially the rate index is a very tricky thing. I think coming out with a sample based rate index. Now, those kind of, there will be a lot of, back and forth with the management. If you give them a bad rate index, and then all the sampling will be questioned and they will ask, how did you really rate this? So there is a lot of, whenever there is some, auditor uses some framework for this rating, I think that should get approved by the board level so that there is no confusions later on. I think that is important from a risk rating standpoint, because I've seen this in my professional life, that anything that we rate, if it is not approved at a very highest level of audit committees, and then there are a lot of dependencies on, it could go this way, a good rating or a bad rating, I think it will be questioned. So very good, articulation of the framework and what is expected of the internal auditors, and thanks for sharing all those insights. Yeah, so both of you, it's been more than an hour and a half, and have a lovely evening. And thanks for sharing all this, material. We look forward to more such, programs from your side.
Yeah, thanks, Giri. Thanks, Ravi, for giving me and Kalpita this opportunity. Thank you.
Thank you, sir. Thank you.
Thank you, Giri. Thank you, Milind.
Thank you so much.
Bye-bye.